So what are some of the things that you should never do in retirement? Plus, are you a victim of your employer's desire to avoid liability? More importantly, is your investment results a victim of your employer's desire to avoid liability when it comes to offering you investment options in their retirement plans? We'll talk about all of that on the program. We hope your Thanksgiving went well this past week, and perhaps you're out, well, no, you're not out shopping in the middle of a pandemic. We can pretty much see that from the reports on the media, but maybe you're online and clicking away and enjoying some shopping from the comfort of your pajamas. We hope that your Thanksgiving went well at the Garris house. We had the grandparents and all three of the boys home. Of course, with mixing of the generations, we kind of had to do what many folks I think might have done for this Thanksgiving, is we sent all three of the boys off to get some COVID tests, and the one on Wednesday sort of drew the short straw. He had to wait like 4 hours for his COVID test, but everybody came back negative, so that's good, and was able to enjoy the holiday, as I hope you were as well. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your money. We're Central Florida's longest running radio program, coming to you here on Sunday mornings from 96.9 The Game, along with the News Radio WFLA Orlando network. Also, our podcast, Dollars and Cents with Joel Garris, happens to be one of the top 25 financial planning podcasts on the World Wide Web, with over 13,000 downloads of our episodes. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides peace of mind for the future. So, big milestone, I guess, this past week with the Dow crossing 30,000. So we have to talk about that right out of the gate, because that is a milestone that's getting a lot of attention in the media, in the press. And so we wanted to share with you some thoughts on sort of what that means and help to give some perspective. So we'll start off, as we like to do, with conversations about what the markets are doing with a little bit of a historical perspective, right? So the Dow first crossed 10,000 on March the 29th of 1999, a little over 20 years ago. From there, it hit 20,000 for the first time. It closed above 20,000 for the first time on January the 25th of 2017, so about 4 years ago. And then this past Tuesday, November 24th, it crossed or closed at above 30,000. So media loves to kind of look at these nice round numbers and make a big deal about it. And yeah, certainly it is noteworthy to say the least. But we've got some thoughts that we kind of wanted to share with you on it, 5, if you will, in particular, if you like to keep score at home. And the first of which is, we encourage you to remember your 6th grade math. Maybe it wasn't maybe it was 7th grade. Anyway, the math goes like this. When the market gains 10,000 points, it means less than what it used to. So we'll apply a little 6th grade math to it, and when you go from 10,000, right, to 20,000, that's 100% increase in that market index of the Dow. When you go from 20,000 to 30,000, that's a 50% increase. Still good, but understand that the issue with larger numbers is that the absolute value of those and their contribution to your net worth starts to shrink, right? So if you take it one more step, 20 to 30,000, right, on the Dow is a is a 50% increase. So if you go from 10,000 to 20,000, that's a 100% increase. You go from 20,000 to 30,000, that's a 50% increase. When you go from 30,000 to 40,000 on the Dow, well, that's only a 33% increase. So understand sort of how the math works. The 10,000 points doesn't mean quite as much as it may have originally, particularly as those numbers get larger. The larger the denominator, the smaller the percentage, if you will, of gain on that. So remember that sixth grade math and sort of the importance of 30,000. Still pretty good. Still means the market's going up pretty well, which I guess gets us to the second point, is that new highs in the market are to be expected, right? I mean, if you look at the past 100 years, it's a upward trend in terms of the value of the market. And why is that? Well, that's because the global economy continues to expand, right? More and more people find themselves not living below poverty or not living with just a meager existence. The standard of living of the world at large is gradually increasing, right? There's a lot less people living in huts these days than there were 50 years ago, right? So that means that there's an upward increase in the total value of the global economy. Consequently, that gets measured by the market indexes as well. So that means that as the global economy goes, as consumerism goes, as all of that growth happens, then the markets, yeah, they should really kind of follow that generally upward trend, which is what they've been on. So certainly higher highs are to be expected. Number three, if you will, is something that we always know about the markets, is that it's never a smooth ride. So if you look at that period of time of the last 10,000 point increase from January of 2017 to just this past week, going from 20,000 up to 30,000, then it's never a smooth ride. So in that 4-year window, you had two substantial declines. One, 19%, that occurred a couple of years ago in January of 2018, in December of 2018. And then the other one was, of course, the 37% decline that happened in March as a result of COVID. So understand that it's never really a smooth ride, if you will, out there. Number four, and I think this one is kind of noteworthy, we think that 3,638 is a way more impressive number than 30,000. What's 3638? Is that the pick four numbers for the week? No. It's what the S&P 500 closed at on Friday. Why is that important? That's a new high for the S&P 500 as well. Doesn't roll off your tongue like 30,000, doesn't catch as much attention as a nice round fat number like 30,000, but 3638 is a pretty good number, particularly when you think about it as a new high for the S&P 500. And the reason that's important, right, is because the S&P 500 represents the valuation of 500 of the largest companies in America versus the Dow, which is only like 30,000. And a lot of that movement on the Dow, because it's only 30 companies, can be traced to basically three companies. In fact, one of them, Apple, contributed almost 25% to that run-up of the last 10,000 points. And then almost 2/3 of that entire 10,000 came from three different companies: Apple, Microsoft, and Salesforce. So 3638, much more impressive number. And then lastly, just because the market's hitting new highs, it doesn't portend the future. It doesn't mean that there's a crash around the corner. It doesn't mean that the market's going to the moon. What it does mean is that you've been an equity stock investor. Chances are you've done pretty well of late. So take that and be happy with those results. If you need money, let's say you need money, you've got something coming up in 2021, maybe it's a car or remodel or something like that, we would encourage you, it's probably a pretty good time to grab some money out. If you're still investing and still working towards retirement, then keep doing what you're doing. Stay consistent and stay diversified, because ultimately those are the best paths to get results over time. So what does it mean? It means it hit 30,000. It's just a number the reality is, remember those 5 other points that we just talked about for some perspective. We're going to take a break. When we come back, we will continue the conversation here on Dollars and Cents. Victim, or more importantly, is your investment results a victim of your employer trying to avoid any liability whatsoever when they offer you options in their retirement plan that they're providing to you? When you look at some of these numbers, it's really going to jump out at you just how staggering the gap in performance is for what's become really one of the biggest rages out there over the past few years. And what we're talking about, of course, is target date funds. So what are they, how they work, how they get to be so popular, more importantly, what's the relative performance? We're going to tackle all of that in this segment on the program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on 96.9 The Game, along with News Radio Orlando Network. Plus, of course, this podcast, one of the top 25 financial planning podcasts on the World Wide Web, with over 13,000 downloads of our episodes. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So these target date funds, I'm sure if you've looked at your lineup of available investment options in whatever it is that your employer offers to you, whether it's a 401k, a 403b, a 457 deferred comp, any of those options that the employer offers, what you'll probably see is that half or maybe over half of the available investment options are all these target date funds. And they're the funds that have like a target date, and then they have a number after them. So it's like, might be like 2030 fund or 2050 fund or 2060 fund. And how they're supposed to work is that the number in them represents a year, and that year is supposed to be matched with what your expected retirement date is. So let's say you're 30 years of age and you plan on retiring in 30 years, then today you would look to be picking like a 2050 kind of fund. That's sort of how they're supposed to work. And in fact, a lot of retirement plans offered by employers these days will default you into that. Like if you don't make a choice, it'll automatically look at your date of birth and then boom, match you up to whatever year it is, or close to whatever year it is, when you would turn age 65. So these have become all the rage, they become all of the default. And as you might well expect, the closer you get to that year, right? So like 2050 is designed, or supposed to be designed, keyword there, supposed to be designed, to generate more of a return, be more growth oriented, if you will, versus a 2030 fund. Okay, well, that's 10 years away, so maybe that starts to shift to maybe like a growth in income, get a little bit more conservative, get a little bit more bonds in there, and then like a 2020 fund would be much more on the bond side of things. But if you've got a number of years out, 2030 or 2040 or 2050, or even some of the funds out there now that are 2060, you should expect all those types of funds to be predominantly on the stock side of things. So that helps to give a little bit of perspective of what these funds are and sort of how they work. The problem is that these funds are supposed to sort of help you through the selection process. The reality is that they were invented really to reduce down the employer liability. So the employer could say, well, wait a minute, you had a prepackaged option that you could have gone into. The reality is that these prepackaged options, these target date funds, have a tendency to be much more conservative than you would expect them to be at these earlier years. And in fact, a lot of those funds where you think 2030 fund, you look at your lineup, right? You got like 11 different of these target date funds in your 401k as part of the investment options, or your 403b as part of the investment options, right? You look at them all and you're like, wait a minute, that's a bunch of different funds, right? I got a 2010 or 2020, or usually the 2010s. When the years roll off, they refer to them as the income fund. So you got the income fund, you got 2020, 2025, 2030, 2035, 2040, 2045, 2050, 2055, 2060, maybe even there's a 2065 fund in there. Okay, so hey, there's my lineup, right? I got 11 different funds. It sounds like I got a bunch of different things to choose from. Here's the crazy part. If you look at pretty much all of the funds north of 2030, and we did this analysis with a major provider, probably the largest provider of target date funds in the industry, okay? And we looked at every one of those funds from 2030 on. 2030, 2035, 2040, 2045, 2050. I'm not going to go through that now again, but it's like 8 different funds, right? So what was crazy when you look at that, you think, oh, those are 8 different funds, right? You look at the performance over the course of the past 5 years, and on those 8 different funds, supposed to be different, they're all got different, years on them. The 5-year annualized return was either 8.6 or 8.61. Stop and think about that. Got 8 different funds, all targeted to different years. Over the course of the past 5 years, basically the performance is within 1/100th of a point on an annualized basis over the course of the past 5 years. Folks, those are the same thing. That's the same thing. When performance is within 1/100th of a point, that's the same thing. So what are you getting with all these different funds? Oh, and by the way, here's the really tragic part of it. Let's say you're looking at those funds 2030 on out to 2065. That should be a pretty growth approach, right? I mean, if you're planning to retire in 2040, that's 20 years away. It should probably be pretty market oriented, right? 2060, be pretty market oriented. But the real problem now is in the performance. So if you just take a look at like an S&P 500 index fund, right? We're talking about the S&P 500 in the prior segment hitting new high. If you look at the S&P 500, over the course of the same 5 years, the annualized return on the S&P 500, 11.7. But every one of my outlier target date funds, 2030 and beyond, up to 2060, 2065, was at 8.6. So here you are, you're trying to do the right thing, you're trying to take money out of your paycheck, you're trying to put it into your employer retirement plan, you're trying to do all those things the way that you know you need to do to save for your retirement, and you're just getting screwed. No other word for it. Because if you're using a 2040 fund or a 2050 fund and the performance is basically exactly the same, but the performance is only 75%, 25% less than what you would get just by owning an S&P 500 index, holy mackerel, that is a dramatic impact on your retirement and how much you're going to have later on. So folks, I understand that that's probably the majority of the investment options that are available to you in your employer retirement plan, but there's some things that you've got to do to avoid this massive underperformance that is happening when people use target date funds. Because they're all the same once you go past 2030. You look at the numbers. Look at the numbers. If there's a variation of only 1/100th of a point on 8 different funds that are supposed to track over a 35-year period of time, it's the same thing. You've got to look at the other options. Here's what you can do. First and foremost, if you no longer work for that company, or if you're over 59 and a half and you still work for them, you probably have the option to roll that money out to an IRA that will allow you to choose from all of the available investment options that are out there, from the entire universe, if you will. From that universe, you got some work to do to thin down to make sure you're owning the right stuff. But at the end of the day, that's going to be a much better allocation than the allocation that is only returning 75% of what it should. So if you're no longer employed, easy process, roll it over. If you're over age 59 and a half and still working, most employers in today's world will give you the option to do what is known as an in-service rollover distribution. That will allow you to escape out of the plan that your employer, in their most magnanimous way, has given you to something that ultimately you have the control over. If you are stuck, meaning you're under age 59 and a half and you're still working, folks, you've got to look at all of the available options. There still is usually about half a bunch of options, 10, 12 other funds that you've got to look at, that you've really got to look at those choices and select from those other choices that are available in your 401k. You're gonna have to do some homework there for yourself on that. If you use a financial advisor, we would encourage you to talk with them, make sure that they take a look at that, and ultimately help to figure out what the right allocation is for you. And they should, by the way, do that for free, because after all, you're using them for their services. Anyway, we're going to take a break. When we get back, we will continue the conversation here on Dollars and Cents on News Radio WFLA Orlando. What are those things that you should never do in retirement besides bungee jumping, race car driving? You know what? I'm going to also put in this list climbing ladders. We seem to have had a lot of folks over the years that wind up hurting themselves pretty badly when climbing ladders, which I guess is why I was more than happy to let our younger associate at the office, Garrett, go ahead and climb up a ladder and put the lights on the roof of the office. As many of you know, our food drive, our toy drive for Toys for Tots, our food drive for Central Harvest Food Bank kicks off this Tuesday. It's the first day of December, so we thought it would be good as people drop by their stuff to see an office that was decorated. First year, I think we've really kind of done that in as much of a fashion as we have done, and so one of the conversations was, well, we need to hang the lights off the off the roof. And I was like, well, y'all can do that. I'm not getting up there. So one of our younger associates, Garrett, happily climbed up the ladder and did that. But anyway, you probably don't want to do that if you're nearing retirement, because the reality is that you just don't have the same level of agility as you might have had in the future. So besides that, let me get on point here in terms of some of the things that you should never do in retirement. First and foremost, something actually that's going on right now is that you should never go without supplemental Medicare coverage. We're in the open enrollment now, all the way between now and December 7th. That gives you the opportunity to kind of change the plan, look at options. Remember this, Medicare Part B only covers 80% of those doctors and prescriptions and things like that. It doesn't actually cover prescriptions, you got to do Part D on that, but doctor visits, things like that, it only covers 80%, right? So that means you're on the hook for another 20%. That's why you need a supplemental policies to cover that 20% that it doesn't cover. Because the reality is that on that 20%, that can add up quickly, obviously, with healthcare costs, and there's no cap on it. So that can be an unlimited number depending upon your health situation. So if the supplement looks too expensive, there's certainly options to explore, particularly with Medicare Advantage. So you may also want to look at that as an option if you're considering, maybe I want to try and run the risk of, I'm not going to bother to go with supplemental Medicare coverage because it's just too expensive. We would encourage you to, if you're going to, not to take that risk, but rather to look at perhaps Medicare Advantage as an option for you. So that's number one. Don't skip that. You really look at the options to be able to have that for yourself, so you've got that coverage. Number two, and that this probably makes sense for anybody of any age, but don't take a credit card and pay for discretionary spending with that. That can really create an issue, because obviously credit cards come with a high interest rate. And the reality is that you want to be using that credit card only for things that you're planning on paying off. If you're using that for discretionary spending, what happens there is that now that cost of that item that you got on a discretionary basis really starts to increase because of the high interest rate that comes on credit cards. And then it also raises your monthly expenses, right? Because now you've got the credit card bill that you have to pay. They're charging you a bunch of interest, and so consequently it kind of gets you into a bit of a vicious circle when it comes to that. As Nancy Reagan said, just say no when it comes to using credit cards. Of course, she didn't mean that with credit cards, she meant that with drugs, but the reality is that credit card spending can actually be a bit of an addiction for many people out there. So make sure that, particularly this holiday season, when you're not even having to go out, or you can't go out, but you're online and doing a lot of online shopping. So just be aware of that. Be careful with that. At the end of the day, don't use a credit card for discretionary spending. Number 3 is not having a balanced portfolio. Again, this one almost is true for a lot of people. And when we talk about a balanced portfolio, we're talking about balance between risk versus return, right? If you're too conservative, then your return is going to be too low, particularly in today's interest rates environment. If you're too aggressive, maybe you've got a much higher level of volatility associated with that. It has to be that balance, particularly if you're retired. It has to be that balance between growth and income. That's what we classically refer to as a growth and income approach. So you've got some parts that are generating out income, more on the cash or bond side of things, and then other parts, stocks, that are generating out more on the growth side of things. So, and that's important because there's 2 factors, right? There's longevity, which is the fact that all of us are living longer, hopefully, right? And number 2 is this notion of taxes, inflation, and low interest rates. So kind of a double-edged sword as to why now more than ever, with longevity and low interest rates and taxes and inflation, that you've got to really have a portion of your portfolio continue to stay on the growth side of things. And we think it's important to kind of not just look at, kind of an easy pie chart or something like that on it. You've really got to drill down and see what it is. What types of companies do you own? Are they large companies? Are they small companies? There's a difference there in terms of volatility and return. The debt, what is it that I own? Is it mostly AAA rated, or is it not AAA rated? And there's a difference there, right? AAA rated, more secure, more likely to be able to continue to make those interest payments. So dig down a little bit deeper. When we talk about a balanced portfolio, from 30,000 feet, it's about the mix between risk versus return, stocks versus bonds, addressing longevity risk, low interest rate risk. But it's important now, I think, more than ever, to drill down a little bit more and look at the types of companies, the sector exposure, the regional exposure, the quality of the bonds that you've got. You really got to kind of take that one step further than perhaps what you might have otherwise done. And then lastly, something to also make sure that you don't do in retirement, and that is to start to withdraw your retirement income without any strategy for where it is coming from and how much is it going to be. So in terms of how much, remember sort of the traditional 4% rule. It's something that you hear a lot about. A lot of people don't like percentages, so we like to go to division. So the 4% rule also translates to simply dividing by 25. So if you have a easy math, $1 million, divide by 25, that's 40,000. That tells you roughly how much income you could reasonably expect to generate out of that investment. So remember the 4% rule, or if you're not a big math fan, divide by 25. Sort of gets you the same number. So that helps to sort of determine how much, and that can certainly be more than that 4%, depending upon the investment allocation, your personal situation, your age, things like that. And then, the other part of that is from where, right? Because there's different places where you can take income from, and there's different places that have different tax implications on it. And this is where, again, you want to get more specific. Like we were talking about looking at the investment portfolio, how it's balanced, how it's allocated in much greater detail than what you might otherwise have done. Particularly on the tax side of things, you want to be doing the same thing, not just a back of the envelope kind of quick fix on the tax, but maybe even put the numbers into a tax software program that generates out exactly what your tax implications will be when it comes to generating income from different accounts. So know that there's a difference between after-tax accounts and taxable accounts, and that's going to drive a lot of what goes on your return. So certainly some things to be thinking about, and things that you don't really want to do in retirement, or certainly trying to avoid that. A bunch of those things, though, had a lot to do with people of any age. So we're going to take a break. When we come back from the break, we'll continue the conversation here on Dollars and Cents. Up next, things that you don't want to miss out on with respect to Social Security. Coming up next year on Dollars and Cents on News Radio, WFLA, Orlando. What are some of the ways to miss out on Social Security? Because if you know the ways to miss out on it, then hopefully you'll figure out ways to not miss out on it. So certainly we want to look at Social Security as one of the most important things in terms of our retirement, because that's a check a month that comes to you courtesy of the federal government based upon all of the years that you've worked over the course of your working life. And so it's pretty detailed analysis. There's actually a credential out there called the National Social Security Advisor. One of our associates at the office, Rob, is also has that credential, got that a couple of years ago. And so that is such a detailed analysis in terms of when to collect and how to collect and all that, that it's important to certainly have some expertise on that. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. So what are some of the things that you need to be aware of so that you don't cut yourself short when it comes to Social Security? And I think one of the things that we often see people sort of forget is that Social Security, or the amount that you're going to get from Social Security, is in fact a 35-year proposition. That's how much your Social Security is based upon. It's based upon your work history over the course of the past 35 years. It's not based upon sort of the highest five or anything like that. It really does look at the 35-year, which is intended to look and reflect your entire work history from, ages of like 30 to 65. So it takes a look at that. So understand that each year sort of matters to the tune of about 3% of what that would come out to be, right? Because if you look at 35 years, each single year roughly contributes about 3% of what that total average is. So that's number one. Know that it's a 35-year proposition. Number two, know your full retirement age. And this is where it kind of gets a little murky right now, because Social Security is in the process of transitioning that full retirement age from 66 up to age 67. So what happens particularly now and over the course of the next 3 or 4 years is you see that age ratchet up. So this year, 2020, born between the 1943 and 1954, you would be turning age 66 in the year 2020. This is the last year where age 66 is your full retirement age. Over the course of the next 4 years, 2021, 2022, 2023, 2024, 2025, 5 years, then that increases by 2 months every year. So next year, your full retirement age is 66 in 2 months, and then it adds 2 months every year after that, until such time as after the year 2025, then once you're born in 1960, then your full retirement age is age 67. So be aware of your full retirement age, because that's the age from which the calculation is made that reduces your Social Security if in fact you are taking it early. And I know a lot of people advocate wait as long as possible, and that certainly is a fine strategy. We would probably err more on the side of taking it earlier rather than later. There's a long period of time to wait until you'll break even, usually about age 78 or 80. And the reality is that people need more money during the first few years of retirement than they do in the latter years of retirement. A bunch of studies on that confirm that. And when you stop and think about it, when I'm younger, I'm more able to do things. If I'm more able to do things, then that takes money. And so consequently, you can see where in the first few years of retirement, you would need more money than perhaps what you might need in those later years. So again, the reason it's important is that the full retirement age is it adjusts on a monthly basis downward. So for every month that you're taking Social Security before your full retirement age, it reduces the benefits of that Social Security by 0.05%. So whether your Social Security age, full retirement age under Social Security is 66, or 66 and 6 months, or 67, it makes a difference if you're taking it early, because that calculation is going to be made based upon the number of months away from your full retirement age. Another reason full retirement age is important is if you're still working, then if you're under your full retirement age, and you got to make sure that the amount of your work income, not retirement income, pension income, or dividends or rental income, work income is below $19,000 if you're under your full retirement age. If you're over your full retirement age, then you're fine. Number 3, make sure you verify your earnings. You get an annual statement every year. You can log on anytime. Make sure you verify those earnings, because if that's off, then that's going to certainly throw off what you're going to get with Social Security. And then lastly, not realizing that Social Security is taxable. It is in fact taxable. Depending upon how much other income you have, it can be included as much as 85% in your income, and thereby having to pay taxes on it. So certainly some things to think about when it comes to Social Security. We're going to wrap it on up and get on out of here. Thanks for listening to this week's program here on Dollars and Cents. This is Joel Garris with Nelson Financial Planning. News Radio, WFLA Orlando 96.9, The Game.